All right, let's jump right into one of the most critical chapters for your CA exams, declaration and payment of dividend. Now, this chapter is an absolute goldmine for marks, but trust me, it's also a minefield of potential traps set by ICAI. Don't worry though, we're going to walk through it step by step so you can navigate it like a pro. Okay, so picture this common exam scenario. The board of directors sits down and says, hey, we had a good year, let's recommend a 20% dividend. Then, at the annual general meeting, the shareholders are ecstatic. They're looking at the numbers and thinking, we did way better than that. So they all unanimously vote to bump it up to 25%. So the question is, can they do that? Is that resolution valid? We're going to find out the definitive answer in just a minute. All right, first things first, let's lock down the basics of dividends. You have to get these core rules down cold because everything else we're going to discuss is built on top of this foundation. ICAI loves to test these fundamentals, so pay close attention. So what exactly is a dividend? Well, the legal definition in the Companies Act is super short. It basically just says dividend includes any interim dividend. Not very helpful, right? So think of it this way. It's the company's way of saying thank you to you, the shareholder, for investing your money and trust in them. It's your share of the profits, your return on investment. Okay, this slide is absolutely crucial. This explains the entire power dynamic. It's a two-step process. First, the board of directors recommends the dividend rate. Then, that recommendation goes to the shareholders at the AGM for a vote. Now, what can the shareholders do? They can approve the rate the board suggested. They can even decide it's too high and reduce it. But, and this is the golden rule you cannot forget, they can never, ever increase it. The board's recommendation is the absolute ceiling. That's it. Full stop. Here is a classic exam trap, and I see students fall for it all the time. Dividend is always calculated on the face value or the nominal value of a share, not its market price. So if a share has a face value of 10 rupees, but it's trading on the stock market for 250 rupees, a 20% dividend is 20% of 10 rupees, which is just 2 rupees. Don't let that high market price fool you. And this brings us right back to our opening question. The answer is a huge, resounding no. It is completely invalid. It doesn't matter if the vote to increase the dividend from 20% to 25% was unanimous. The board recommended 20%, and that is the maximum allowed. This is a massive ICAI trap alert. Please burn this rule into your memory. It will save you easy marks. Now that we've nailed the basics, let's talk about the two main types of dividends you'll encounter, interim and final. As you're about to see, the biggest difference between them really comes down to timing. So what's the deal here? A final dividend is the standard one we've been discussing. It's recommended by the board and then officially declared by the shareholders at the AGM, but only after the financial statements for the year are finalized. An interim dividend, on the other hand, is declared by the board of directors all by themselves, somewhere in the middle of the year, between two AGMs. It's based on the profits the company has made so far, even before the final accounts are ready. Now pay close attention because there's a very specific and important rule just for interim dividends that ICAI loves to build case studies on. If a company has actually incurred a loss in the current financial year, up to the end of the quarter right before they want to declare this interim dividend, then there's a cap. The rate of the dividend they declare cannot be higher than the average dividend rate of the past 3 financial years. It's a crucial safety net. Okay, so we know when dividends are paid. But does every shareholder get the same treatment? Not at all. Your rights to a dividend can be very different depending on the kind of share you hold. Think of it like a pecking order or a queue. And right at the front of the line are the preference shareholders. They have a preferential right, meaning they must be paid their dividend, usually at a fixed rate, before a single rupee can be given to the equity shareholders. The equity shareholders get whatever is left over. But even within preference shares, there's another critical distinction. With cumulative preference shares, if the company doesn't have enough profit to pay your dividend one year, it doesn't just disappear. It accumulates as arrears. It's like an IOU from the company. All of those unpaid arrears must be paid off in full before the equity shareholders can get anything. With non-cumulative shares, it's a use it or lose it situation. If there are no profits, you don't get a dividend for that year, and that right is gone forever. All right, so the board has decided to pay a dividend. Where can they legally get the money from? This isn't as simple as just checking the company bank account. The law is very strict about which sources are permitted. Section 123 lays it out clearly. There are basically 4 pools of money you can use. First, the profits from the current financial year. Second, the undistributed profits from previous financial years, which are basically your savings. Third, you can use a combination of both. And fourth is a special case, money provided by the central or state government specifically for paying dividends under a guarantee. Now wait, before you can even calculate the profit available for dividend from the current year, there is a critical, non-negotiable first step. You must set off any losses carried over from previous years and any depreciation that wasn't provided for in those past years. You have to clean up the past accounts before you can distribute the current year's profits. This is a point where marks are often lost. And here's another very common mistake. Let's say a company revalues one of its properties, and on paper, its value goes up by 20 lakhs. Can they distribute this profit as a dividend? Absolutely not. Unrealized or notional gains, like those from revaluation, are not considered free reserves. You can't pay dividends out of paper profits. It has to be real, distributable profit. Okay, let's tackle a common point of confusion. The old Companies Act had rules that required companies to transfer a certain percentage of their profits to reserves before they could declare a dividend. The question is that still mandatory? The answer today is simple. No, it is not compulsory. A company now has complete freedom and discretion. It can choose to transfer 10% of its profits to reserves, or 50%, or nothing at all before declaring a dividend. It's entirely their call. So if you see a question mentioning a mandatory transfer, you know it's a trap. Now, this flexibility is great when a company has profits, but what happens when it doesn't? And this brings us to the climax of the chapter. This is probably the most tested and most important part. What happens when a company has inadequate profits, or even a loss, but it has a healthy pile of accumulated reserves from past years? Can it still pay a dividend to keep its shareholders happy? The answer is yes, but only if it can pass 4 very strict tests. To do this, the company has to satisfy all 4 of these conditions from Rule 3. Not 3 out of 4, all of them. Let's break them down. 1, the rate limit. The dividend rate can't be more than the average rate of the last 3 years. 2, the withdrawal limit. The total amount you pull from reserves can't be more than 10% of your paid-up capital plus free reserves. 3, loss set-off. The money you take out must first be used to set off the current year's loss. Only the leftover amount can be used for dividends. And 4, the reserve balance. After you take the money out, the balance left in your reserves must still be at least 15% of your paid-up capital. Fail even one test, and no dividend can be paid from reserves. So let's see how this works with the Capricorn Industries example. First, we check the rate limit. We average the last 3 years' rates, 9, 10, and 12%, and get 10.33%. That's our ceiling. Second, the withdrawal limit. We take 10% of the paid-up capital and free reserves combined, which is 10% of 440 lakhs, giving us 44 lakhs. That's the maximum cash we can take out. Third, the loss set-off. The first 30 lakhs of that withdrawal has to be used to cover this year's loss. And finally, we do a check on condition 4 to make sure the remaining balance in reserves is sufficient. After running through all the conditions and the related calculations, we find that the maximum dividend rate that Capricorn Industries can legally declare is 10.33%. This systematic, condition-by-condition approach is exactly how you need to structure your answer in the exam. And let's end with a final thought to really solidify this concept. Could a company with massive reserves, we're talking thousands of crores, but a small loss this year, legally pay out a huge dividend? Think about it. The rules, especially the rate limit based on past performance and the 10% withdrawal limit, act as a brake. They prevent a company from recklessly draining its savings in a single bad year. And understanding that check and balance is the key to mastering this chapter.